Welcome back to America's Commercial Real Estate Show. I'm Michael Bull. This segment is brought to you by CommercialAgentSuccess.com. Check it out. It is incredible training for commercial real estate agents. Well, today we're talking about commercial real estate vectors for 2020. We have KC Conway here with us in Studio One. He's a senior economist for CCIM. And before we took the break, we talked about retail. And one of the property types that seems to be going through some changes as well as retail is the office sector, right? We have this big, I don't know what you'd call it, from the
cluster,
yeah, from WeWork. But what do you expect for office market moving forward?
Yeah, so I'm still cautiously optimistic. I don't think that the demise of WeWork is the end of either the co-working concept or office. There'll be a little bit of space to digest in New York and maybe Atlanta and definitely London. But keep in mind, most of that WeWork converted space, someone spent a lot of capital to convert that to great, creative, open office space stuff. So from a capital standpoint, it's in pretty good shape. So those landowners or those building owners with that space, I think, are in pretty good shape. The co-working concept's not dead. This has been evolving for quite a long time. Things like lease accounting are driving it, forcing companies to really work on their efficiency ratios and not have long-term leases. And so I don't think it's dead at all. It doesn't decimate any one market here in the United States, maybe a little bit in New York, but the rest of us are in good shape. And, companies and industries, especially the financial service industries, they need this co-working concept to work. So I don't think it's dead at all.
Yeah. Well, what could community leaders, what should they think about to kind of keep their communities vibrant? I mean, it's not just attracting new office tenants, is it?
It's not. Boy, and I tell you, you're right on, Michael. I tell you, I grew up in Colorado, for those of you who don't know me, and I was known to have an occasional Coors beer along the way. That pure Rocky Mountain spring water, right? Brush my teeth with it occasionally on a camping or ski trip.
The beer or the water?
The pasteurized kind. And so, I don't know if many of you read, but recently, but Coors is going to move its headquarters from Colorado to Illinois. And I'm just fell out of my chair, never thought I'd hear that in my life. But it really was a wake-up call. We saw it here in Atlanta earlier this year when SunTrust Bank announced its merger with BB&T, and that headquarters, the bank that underwrote Coca-Cola, has a little baseball field named after itself. They're moving to North Carolina. And it's a wake-up call that in our economic development leaders and our politically elected leaders, we need to pay as much attention to economic retention of what got us here in each of our cities as we do trying to lure new tech companies that still haven't made a profit yet. So I'll go with those economic retention. So economic retention attention is an important thing for our economic leaders right now.
Yeah, I mean, I think you sometimes can take it for granted. They're big and they're powerful and they're in your community, but if they leave, you're gonna hear about it. And it's, in commercial real estate, we all think about it in a big way, because we're thinking about it as retaining tenants in all of our buildings all the time, right?
Right.
We know turnover costs us. Take care of the tenants and just take care of the communities, just taking care of the businesses themselves. Well, what about industrial moving forward? I mean, is it going to just continue on this rapid growth and rapid pace of improvement?
Absolutely. I'm sorry, I didn't have a strong opinion there. No, I mean, industrial is going to be on a growth mode for years to come. We're at only 10% of total retail sales that have gone into e-commerce. Our forecast in our recent paper, Retail Evolution, and our logistics paper earlier this year, forecast that we're going to be at 20% retail sales online by 2025. So that's pretty fast. And so the warehouse is the new department store. And so we may go to physical retail to see a showroom or to do pickup or get deliveries, but the bulk of that inventory is going to be the big e-commerce warehouse. And that's not slowing down at all. We have a record 300 million square feet under development right now. And CBRE tells us that we have a deficit of about 170 million square feet per year for the last 5 years. So we're looking at well over 500 million square feet that we are behind on building. And when you look at this growth pace, I don't see it slowing down at all. And we've got to figure out last mile. So most of this stuff is first mile from the online warehouse and on the online order. Well, how do we do the last mile? So a lot of these older small warehouses, where is Carvana and TrueCar sticking the cars that aren't on the acres of lots that go in the car vending machine? look at Amazon. They've been buying Toys R Us stores to help do last mile fulfillment. So I think we have a long way to go.
Yeah. And to get closer into that last mile, we're seeing some changes in some of these industrial buildings, aren't we?
Yeah, it's like, everything goes back to the future.
Back to the
So Sears and Montgomery Wards in the 1930s and 40s pioneered vertical distribution. So some of you have an old Sears vertical distribution facility that might be repurposed. We have one here in Atlanta, Ponce City Market. If you're in Memphis, they have Crosstown Project is involved in both those deals. And so we are now building warehousing vertical. And there's two reasons that are driving that. The first is the availability of land. So traditionally, it's taken a land to building ratio of 3 or 4 to 1. Now try 7 to 1. Because with the e-commerce, the double tandem trucks, the need for more truck pad parking, all of that is increasing. And so today, when you build a modern building, it's you got to have a 7 to 1 land to building ratio. That's just not feasible in high dense markets like a New York or Miami and Los Angeles. So what we've actually seen is we're seeing a new generation where they're multi-story, about 300 to 500,000 square feet per level vertical warehouses, and they have truck ramps that go up either side and all the pad parking underneath. And so there's one going up in Brooklyn right now that Goldman Equity was involved with. There's one in Seattle, and I think these work very, very well in cities. You can come down to cities with 2 to 5 million in population where you need it close in. The only problem I see so far in the model is Amazon is getting the lease on the upper floor. And I just wonder if they're getting that so they can spy on all the other retailers below and steal their inventory and ship it out the other ramp door. But we're going vertical in warehouse.
Yeah, that's amazing. And the industrial space is, when you think about last mile, some people think about, and you say a small building, that's not a 10,000 square foot building or 20,000 square foot. That's still a 250,000 square foot building that's needed, even if it's close to the city, right?
It can be, and it can get down into the 40 to under 100,000 square feet. We have a good colleague here in Atlanta, Sim Dowdy with King Industrial, and their bread and butter is on working with these smaller, older buildings. And so you have a lot of retailers. Like look at a Levi's. Levi's might not need 250,000 square feet in different tertiary markets. They might only need a 25 to 40,000 square foot space, and they can stealth deliver it into high-end stores in say Buckhead here in Atlanta, or Cherry Creek Shopping Center in Denver, or Scottsdale Mall, or something in Phoenix. So I think some of the smaller apparel, and I think some of the higher end type stuff absolutely can work very well in those smaller. Also the food. So when you look at the food delivery, I think we're going to see some of these closed drugstores become fulfillment centers. We're already seeing Kroger start to partner with Walgreens. And so imagine this is how crazy things get in Back to the Future. So we took pharmacy out of drugstores 20 years ago and we put it in the grocery stores. Now we're taking grocery out of the grocery stores and we're putting it in the drugstores. I mean, I don't know what comes next.
Yeah.
It's in the hotel.
Well, I guess we'll have the fountains back in the drugstores where you can get a milkshake, right?
There you go.
And as we try to look forward to 2020 and beyond, one of the things that we need to think about when we're looking at real estate and the economy and logistics is the ports and their growth.
It absolutely is critical. So I tell people frequently, whether they're an inland distribution market, like say an Atlanta or a Dallas or Phoenix or whatnot, is you need to understand your connectivity to a port. What is your connectivity? If you don't have one and you don't have the rail connectivity, you probably are not going to be an important inland market, distribution market, and you're not going to participate in as much of the logistics. So the good news, we hear about all the tariffs and it's slowing economic growth. When I look at the port activity, particularly in our region of the country, I'll sit there with Georgia, record-breaking numbers, broke 4 million containers this year. Charleston, South Carolina, fastest growing terminal port, another record year in performance. And each of them are building these inland port models where they get the stuff on rail from the port and they get it quickly inland. Even if you go down to Florida, Miami's having a record year. Come around the Gulf Coast, Mobile, Houston, Port Freeport, they're all growing. So these ports are very important. They're kind of like the heart. And what goes from the heart are all the arteries and the veins, and we need a good vital heart, and those ports are the heart of our economic, especially in logistics.
And you mentioned on these industrial buildings that you need more area for the park the trucks, but in some cases you don't need a coffee shop for the people, for the drivers, right?
That's right. So autonomous trucking, it's here. Those of us that thought it's many years away might be surprised that Florida became the first state this year. They passed all of the legislation. both for liability and for the logistics of how the autonomous trucking will work. They're in a position that January 1, 2020, on all state, U.S. and federal highways in Florida, autonomous trucking can function. And the model is going to be kind of like, think of an air traffic control system. So the planes are out there flying, at 30,000 feet, but as they get close to the city, there's an air traffic controller that takes, command or instructions of so many planes and see them that they land. Same model is going to be happening in Florida. In Central Florida or wherever there'll be a command center, and when you deploy an autonomous truck, it'll be registered and handed off to this control center, and they'll see all the way to its conclusion. It might have 10 or 20 trucks that it's overseeing, and they've already determined if it goes rogue and kills a family in Disney, they've already got the price tag for what the cat was worth, the dog was worth, the kids. They've got it all done. It's all already defined.
Ooh, that's scary. I can think about driving down the turnpike and a tractor trailer pulls in front of me or does something I don't like, and I want to give them my favorite hand gesture, whatever that might be. I look up and there's no one there.
that controller will say, "Smile, we're sending you a ticket." But here's the really good news about that. Autonomous trucks don't mind driving in the middle of the night, in rain or inclement weather. So one of the advantages is we're probably going to see this truck traffic move off of our peak daytime levels and into off-peak levels, because the truck driver's not going to fall asleep, doesn't need to stop at a truck stop and get caffeine. The robot keeps going.
Yeah. So you're optimistic, I guess conservatively optimistic, but you're optimistic about commercial real estate moving forward, right?
I'm solidly optimistic.
Solidly, I like that. Okay, better. So what about REITs then? Because sometimes they kind of behave differently.
Yeah, so we saw this last year. So unfortunately, we have these robots to figure out how to trade things in Wall Street. And so last December, when the Fed did its fourth rate hike, the robots were programmed that when interest rates go up and the Fed hikes, what do you do to REITs? You sell them, and they tanked them. The fundamental of the REIT didn't change. Good quality asset, most of them on triple net leases, inflation protected, good locations, none of those fundamentals changed. So what happened when the Fed started cutting rates again this year? All of them came back more than what they lost and have come back. Here's what's driving REITs today. It's a yield play. So if you look at the rest of the world, negative interest bonds, you look at the stock market, maybe a 2.5% dividend, and you look at a REIT with a 4+ dividend in these solid assets, it's a yield play with very solid, secure asset underpinning it. And I think that's the fundamental REIT, and none of that's going away.
So you think in 2020 they do well?
Absolutely. I think this is a nice sweet spot, and I don't see the Fed coming back into a rate hiking mode. And if they decide that they need to do more to offset the negative yielding bonds in the rest of the world, that's only going to benefit the REITs further.
Okay. Let's think about opportunities, KC, out there in the commercial real estate world, maybe in various sectors or maybe parts of the world or parts of the country. What are some opportunities that we might want to think about?
Yes, I'll start with geography. I travel all over the country. I do about 80 trips a year. And a couple of my most recent ones were, those are out west of your viewers, Salt Lake City. I'll just say, oh my God, what an incredible market. New airport, they're right-sized. They're a vacuum before it gets to Austin. They intercede, as a filter. The tech companies coming out of California, really everything going right. Affordability in housing, affordability in labor. They're also sucking out of Colorado. Because what's happening is there's a backlash to the cannabis effect in Colorado. So if you're in the transportation maintenance industry, you have a lot of companies packing up out of Denver and moving into Salt Lake because they can't deal with the random drug test from the cannabis thing. So affordability is a big part. So I look at markets where they have the affordability, low tax, and the workforce. So Texas is in there, Florida's in there, Tennessee's in there. We here in the Southeast, we have a great workforce, great universities, so we're minting a lot of that workforce that we need. We have comparatively low tax rates, so we have a proactive, pro-business environment, so I'm very optimistic there. So earlier when I joked about Flexit, I'm worried about the West Coast and I'm worried about the Northeast, because literally you just sit here in the South and you just watch the vacuuming occurring out of the Northeast. It's high tax, not pro-business, not low cost. It's got a real problem, and I think the same is present in the West Coast California market. So geography, I'm optimistic on that. On property types, I'm very optimistic on housing. And I'm particularly thinking that we can do it on affordable housing. It's going to be more infill, it's going to be more innovative, things like new subdivisions where all the homes are for rent. The ones that are happening, like this All-American Homes example I use, so they're going in and picking up just really bizarre strips of land that you wouldn't think about. A big public builder wouldn't want that because they couldn't have a nice monumented entrance and all, and amenities. They don't need it. They're trying to get single-family housing at an affordable level in good school districts. So they'll take a meandering sliver of land and put the housing up there. They're building these things for $180,000 and renting them for $2,400. The model works. Tiny house subdivisions, manufactured home communities, where we've got manufacturing deploying. I've been a big proponent over at the University of Alabama. We have a lot of manufacturing jobs coming in. We have Airbus down at the port and Walmart's distribution. We have Mercedes. We have Toyota Mazda coming in. Mercedes is adding a new electric vehicle plant. So we have all these manufacturing jobs coming in, and we don't have the housing. And so a manufactured home community, these things aren't what they used to be 50 years ago. Believe it or not, that's not where tornadoes land. It's all that gets reported. But they're affordable. You can build turnkey a manufactured home community with a nice house, with the land and everything else for about $90,000. Compare that to a single-family stick-built apartment. It's over $200,000 a day. So I can deliver 2 affordable multifamily housing units in a manufactured home community to the one stick-built multifamily house. So those are the type of solutions I think we're going to see in housing. And something like Green Street does a good tracking of the commercial property price index, 20% annual returns on manufactured home communities. Can't build it, not in my backyard, great returns. So that's where I see the opportunity in housing. And single family will chug along, but it's going to be around 1.1 million, 1.2 million units, not 1.5 million to 1.7 million.
Yeah.
Office, not a lot of spec. We're going to digest some of the WeWork stuff. We're going to be retrofitting a lot of older, and we're going to see work going into good location retail. So instead of building a new office building, we might find, like at Emory University, instead of building a new office building, they go to North Lake Mall. We're going to see some of that. Pittsburgh is a great example of a mall up there where the former Macy's, Seidman's, is moving their technology group into about 2/3 of the former Macy's, and the other third is going to be an incubator charter school. So we're seeing lots of good solutions on office, but it's not all going to be in your new vertical tower. Retail, I think it's small as the new big. It's adaptive reuse. It's in places where it's aligning with services, less experiential and less services. Hospitality, medical, airports. Look what's going on, say, in the Denver airport, the Atlanta airport. If you hadn't flown to Minneapolis recently, oh my gosh, Minneapolis is like 3 malls, and oh yeah, by the way, they launch a few planes out of there. It's probably adopted retail in air travel better than anybody out there in the country. In industrial, we've talked a lot about it. It's from the last mile delivery. It could be a retail, it could be a drugstore, could be something adaptive reuse in a mall or big box, to the big mega, 1 million square foot distribution centers that are the new department store. So, and in hospitality, I think the opportunity in hospitality, it's still growing fine. The business traveler is healthy. Companies are healthy. Look at those earnings. They're still sending people on travel. And a lot of those travelers now are going to be able to buy retail in the hotel store, and hotels cut those costs. So I'm just looking for the bad news. I can't find it.
And that's good. And it's a good way to end it. I like ended it on good news. Casey, thanks for being with us.
Appreciate it.
And thank you for joining us around the country or around the world. We appreciate you sharing the show and commenting. And connect with us, if you will, on your favorite social media. Until next week, be sure that you always lead, learn, and laugh. And join us for America's Commercial Real Estate Show. America's Commercial Real Estate Show is brought to you by Bull Realty. For customized asset and occupancy solutions, visit bullrealty.com. Commercial Agent Success Strategies. Incredible training for commercial agents. Visit commercialagentsuccess.com.